Today there was the selling off of the markets because of people reporting that the China virus situation was going to be have a lot bigger impact on the earnings of U.S. Companies. It sold off hard, but to keep from getting panicky, the Japanese rice traders tell us that the two most important aspects of a candlestick signal is where it opens and where it closes. It would have been a completely different illustration of what was going on in investor sentiment had the markets closed near the low end of their trading range. But as we can see, the Dow, after being off 370 points at one time, closed off 120 some odd, making an indecisive trading day pretty close to the T line. The NASDAQ closed lower, but it also had an indecisive day and also showed that it was not going to close below the T line. We make this a very relevant observation because we know the probabilities are extremely strong that if you close above a T line, you're still in an uptrend. If you close below the T line, you start a downtrend. So the fact that the NASDAQ did somewhat of an indecisive day and closed well back up above the T line tells us that investor sentiment has not changed yet. The same scenario can be applied to the S&P 500. Again, sold off but came back up as an indecisive day well above the T line. Now, that does two things. The fact that they couldn't close it off very much tells us there hasn't been a change of investor sentiment, because if most investors see that the uptrend is still in progress, that means they're less likely to start bailing out of the market. Again, human nature. But another telling indicator is the transportation index. Note how it closed up strong today, well above the T line. So logic has to kind of analyze the overall market. If the indexes are doing indecisive selling, the NASDAQ and the S&P 500 are closing above the T line, and the transportation index is still trading positive, that's a pretty good accumulative analysis that there isn't any major change of investor sentiment in the overall market. Knowing the T-line rule allows us that when we identify a fry pan bottom pattern like in Rite Aid, we know that even though it's selling off during the day, that we don't need to get worried until we see an actual sell signal and a close below the T-line. Otherwise, the trajectory of the fry pan bottom is still in progress. The same can be seen in our recommendation on ITCI. Fry pan bottom could not close below the T line. REGI, Reggie, same scenario. Note the positive analysis is that they couldn't close any of this trading back below the T line when it started its uptrend. This is not rocket science. This is the way human nature works time after time. All we're doing is identifying the patterns that confirm investor sentiment buildup with the expectation that they could have a big breakout to the upside. This information applies to patterns like the J-hook pattern in our recommendation on our VNC. Same scenario. As long as we're trading up above the T line, we can stay long. Just those factors, the combination of candlestick signals and patterns and the location of the T line, dramatically improves your investment capabilities, because every time you see a pattern set up and it's confirming, you know that the probabilities are greatly in your favor. And a major benefit of knowing what patterns and wedge patterns from Western investment terminology, that when we see a pattern set up, we know that if it breaks out, we're putting ourselves in positions where the probabilities are great that you might have a big, strong price move. Does that mean that happens every time? Not necessarily. It just means the probabilities of being in those type of situations are greatly in the Candlestick's favor, Candlestick investors' favor. That'll be it. We'll see you in the chat rooms.